Good morning, good afternoon, and good evening, and welcome to the Extra Innings Quarter One update here at 9 Innings Capital Group, hosted by Kevin Thompson, the founder and CEO of 9 Innings Capital Group. Today, we're going to talk about exactly what happened in Q1 and where our economy is headed from there. It's going to be very, very quick. It's just meant to be quick, specifically informational. So let's go ahead and let's get started. So with our help from our friends there at JP Morgan, they provide us some very, very good insight on the markets, on the economy, and we greatly appreciate what they have done for us. And we're going to use some of the guide, some of the pages in the guide of the market to give you a little bit of explanation. So we're going to start with COVID. I know people are tired of hearing about COVID, but it's very important to know exactly where we have been and where we're going. So back in January, we were having about 250 to 260,000 cases, confirmed cases on a daily basis. Now, as you can see, we've actually come down significantly, and we were sitting about 50,000 cases, confirmed cases a day in March. Now, one thing we've noticed is that with a lot of economies, a lot of states opening up their economies and getting everybody back out there, opening up businesses and things like that, we've seen a little bit of a spike in COVID confirmed cases here recently. So even though those have come down, confirmed fatalities have actually come down as well. We're starting to see a little bit of a spike in regards to new cases, confirmed cases, and quote unquote fatalities here as well. So be very, very careful as you head out and back into the world and we open the economies back up. We got a very good employment number just last week. We had over 900,000 jobs that were created back in our economy. A lot of those jobs were lost back with COVID and in March of last year. Those jobs have now come back from restaurants, from just everyday service. A lot of jobs in the service community. Those jobs are now coming back in record abundance. So what's also interesting is that not only in the service community, but also in the government, there are also jobs that are coming. Also in construction, there's jobs that are coming. So there was a very, very robust report that we just saw last week. However, the revisions were even better. Revisions for February, revisions for January were all in the right direction. They were all positive revisions. So very, very strong jobs report. And it looks like our economy is starting to turn around. And as you can see, the 50-year average in the unemployment rate is 6.3%. And that's where we're sitting around right now, 6.2, 6.3% from an unemployment rate. So this is another thing that people want to talk about from a valuation perspective. How much longer can we continue to rise in the stock market? That's a great question. And the language we always use here is don't fight the Fed. Why? Because the Fed does what? They lend in their own currency and they issue in their own currency. When you're issuing your own currency, that means you're creating your own currency. You're doing things in your own currency to create more currency, getting people to work. So you're issuing in your own currency and you're lending your own currency. What does that mean? People are borrowing your currency. So what does that basically do? Well, it allows you to do what? Especially when you're the currency, the world's reserve currency, and you can control interest rates, you're in a very, very good position. So now you've seen valuations in the stock market, especially with stimulus hitting the market. What happens? People have two options with stimulus. One option is going to be, I can save that money or I can spend that money. And generally, a majority of the people, the 90% of the people that are below the top 10%, they have to spend that money. About 50%, 50 to 60% is spent on either a good or a service. So with that being said, that money goes back and it gets spent back into the economy, which again is indirectly tied to the stock market. So now you have an indirect correlation to money going back to earnings for these companies. And then it could be directly tied to the stock market when people say, I want to go and invest or buy a particular stock with those stimulus dollars. So it's either indirectly or directly going into the stock market, which again, you have seen valuations basically go up to almost 22 times forward earnings, which of course you guys all know that we've had a 25-year average of 16.64. Does that mean that we're due for a correction? Absolutely not. But it is something that we definitely need to look at. So at the end of the quarter of March 31st, we were at 21.88 times forward earnings in regards to price to earnings ratio in the stock market, or the S&P 500, which again, is concerning because we're one standard deviation above the mean. You've seen in Q1, you saw a definite rotation out of growth into value. You saw the NASDAQ and everything get hit pretty hard. So this battle between value and growth, let me kind of explain it really quickly. So as you can see on this chart here, if the line here goes above 0, that means growth is cheap and value is expensive. So that's why you've seen over the last several years how growth has outperformed, especially in 15, 16, and 17. However, when you've seen the markets kind of get a little bit toppy, you're starting to see that growth is actually becoming expensive and value is becoming cheap. And that's why you're seeing a rotation, especially in Q1 of this year. You saw a significant rotation out of growth into value, out of growth into value. That's what you're starting to see. So what makes up this growth and value sectors? What are the components of this? Well, that's a great question. So value is going to be considered things like industrials, financials, energy, materials, real estate, utilities. Those are quote unquote the value sectors. The growth sectors are going to be the consumer discretionary, healthcare, information technology, and consumer services, communication services. I'm sorry. So those are considered the growth sectors. So when you're talking about value versus growth, this is what you got to understand. There has been, especially in Q1 of 2021, there has been a rotation out of growth into value, mainly because there's some significant value there, but also because of rising interest rates inside of our market, especially in the 10-year on the 10-year treasury. So when we talk about S&P 500 and index concentration, this is a very, very important topic here because we want to talk about what is driving the S&P 500. The top 10 stocks inside of the S&P 500 make up for most of the gains inside of the S&P 500. As you can see here on the left-hand side, the top 10 stocks are roughly around 30 times forward earnings. Now, this is not necessarily that important. Yeah, they're a little bit overvalued, as you can see here in regards to that. But what's more important is that I want to go over here, the market capitalization as of the end of Q1. The top 10 stocks in the S&P 500 make up 27% of the market cap in the S&P. So that basically means that if those stocks are moving up or down, the S&P is most likely going to move up or down. And the top 10 stocks in the S&P 500 from an earnings perspective, almost 27% of the earnings on the rolling 12 from the last 12 months have been from those top 10 stocks. The Apples, and as you can see down here, we have the Apples, Microsoft, Amazon's, Facebook's, Google's, both Alphabet, Tesla, Berkshire B, JP Morgan's, J&J, and Visa. Those are the stocks that make up those top 10 and the rest of those companies, the remaining 494 companies in the index basically don't really they have an impact, of course, but they have less of an impact in regards to the market moves in the S&P 500. So I think it's very, very important to see how that actually works. So we're talking about sector leadership through this pandemic. So I like this chart because, as you can see, since November to the present, you've had a lot of the value-oriented sectors doing very, very well. Energy, airlines, retail, banks. This goes back to that value-oriented world that we're living in right now. The huge rotation out of growth. As you can see, Previously, before the quarter, there was online retail, home improvement, information technology. Those were doing very, very well. But as you can see now, those are actually doing very, very poorly. Not necessarily poorly, they're still positive, but not doing as well as the value sectors in our economy. So you're starting to see, like I mentioned before, and that sort of rotation out of growth into value for a couple of reasons. One, because value is deemed to be undervalued at this present time. And two, interest rates have gone against growth. Finally, this is my favorite slide as always, the S&P 500 year to date. At the end of the quarter, the S&P 500 was up 6%. You saw some volatility in the market, but very, very little. And in Q1, there was only like a negative 4% peak to trough in market. So there's very, very little volatility right now in our current markets. And that may continue. I don't know. I don't have a crystal ball, but just from the facts, seeing it right here, the market and the S&P 500 ended the quarter up 6%, which is relatively good given the fact that we've been in a quote unquote long bull market over the last 10 years. So I appreciate JP Morgan with these slides. I appreciate the opportunity to have this conversation and speak. And I also appreciate you guys listening to the Extra Innings Q1 update. If you have any questions, feel free to contact Kevin Thompson at www.9inningscapitalgroup.com. You can go send us an email at 9innings@9icapgroup, and we can get you squared away from there as well with your questions. Thank you. Have a great week, and see you next quarter on Extra Innings. Talk to you soon.